Merry Christmas. I know you are likely enjoying time with your family, trying to ignore the chaotic fluctuations of the financial markets for a few days. I intended to do the same. However, I would not be turning this camera on right now if it were not a genuine emergency. I need you to step away from the holiday noise and look at the hard data that just crossed my desk from the other side of the world. The Chinese silver market just screamed a warning that is impossible for any serious investor to ignore. This is not a speculative chart prediction. This is a mathematical fracture in the global financial architecture. Ladies and gentlemen, look at the number currently dominating the Shanghai Gold Exchange, $80.53. I want to be very clear. This is not a typo. This is not clickbait. This is the real verified price of physical silver in Shanghai right now. Specifically, this is the settlement price for the Shanghai Futures Exchange front-month contract, coded as a 2601, which closed at 18,145 yuan per kilogram before their holiday break. Now compare that to the price you see on your brokerage app here in the United States, $71.80. Do you see the magnitude of the problem? That is a difference of $9.27 per ounce. In the professional trading world, we do not call this a spread. We call this a broken market. While the paper markets in New York, where bankers trade digital promises, are pretending the price is in the low 70s, the largest manufacturing economy on earth is valuing the metal at over $80. This is the moment the physical reality of the East officially divorced the paper illusions of the West. To understand why this $9 gap is terrifying, you have to understand how global markets are supposed to function. In a healthy financial system, a price discrepancy like this should be impossible. If silver is $9 cheaper in New York than it is in Shanghai, every bank, hedge fund, and high-frequency algorithm on the planet should be buying every ounce available in the West, flying it to China, and selling it for a massive, risk-free profit. This process is called arbitrage. It is the economic force of gravity that keeps global prices synchronized. Usually, an arbitrage spread is 50 cents or perhaps $1 during extreme volatility, but $9.27. That means the gravity has been turned off. It means the arbitrage mechanism has completely seized up. Why are the world's largest bullion banks not closing this gap? Why are they not buying the cheap silver in New York to capture that free $9 profit? There is only one logical explanation. They cannot. They cannot move the metal because the metal in the New York vaults is no longer there to be moved, or the logistics chain has completely collapsed under the weight of Eastern demand. We are witnessing a catastrophic breakdown in the physical logistics of the silver market. You can trade paper contracts in milliseconds, but you cannot teleport a 1,000-ounce bar of silver. You have to source it, load it, and insure it. Right now, the silver is not showing up at the loading docks. We have reports that refineries are booked solid for 6 weeks, and major vaults are claiming they need 48 hours just to locate specific bar serial numbers. When a vault operator tells you they need time to find your metal, it means the metal is not where it is supposed to be. The engine of the global silver trade has run out of fuel. Why is China willing to pay $9 above the global spot price? Why are they panic buying at all-time highs instead of waiting for a price correction? If this were a speculative bubble driven by retail traders or crypto enthusiasts, we would see irrational exuberance on social media. But the volume we are seeing on the Shanghai Futures Exchange is not coming from retail accounts. It is coming from commercial hedging accounts. The whales buying silver in China right now are not hedge funds or speculators. They are the factory floors of the largest industrial machine in history. We are witnessing an industrial run on the bank. You must understand the difference between a financial run and an industrial run. In a financial run, you simply want your cash back because you fear for the bank's solvency. In an industrial run, if you do not get your physical metal, your factory closes, your workers go home, your multi-billion-dollar company dies because it lacks a critical raw material. That is why they are paying $80, because the alternative cost of a production shutdown is effectively infinity. This is price inelasticity in its purest form. When a manufacturer like BYD or a solar giant needs silver for their assembly lines, the price is secondary to the availability. They are no longer looking at silver as a precious metal or a store of value. They are treating it as a strategic industrial component, much like semiconductors during the supply chain crisis of 2021. They have done the math and realized that the global mine supply is flatlining while their internal requirements are exploding. They are engaging in a game of musical chairs, and right now China is buying all the chairs. Let us look at the primary driver of this industrial panic. Solar photovoltaics. China currently controls over 80% of the global solar panel manufacturing supply chain. For years, Western analysts and mainstream media outlets told you not to worry about silver demand. They claimed that solar companies would simply thrift the silver away, using copper or less silver paste to lower costs. That narrative is officially dead. I have reviewed a recent report from the China Photovoltaic Industry Association. It shows that despite the high price of silver, silver consumption per watt has stopped falling. The industry has hit what we call the thrifting wall. You cannot reduce the silver content any further without sacrificing the efficiency and the lifespan of the panel. But here is the real kicker. The industry is shifting rapidly to new technologies known as TOPCon and heterojunction cells. These new high-efficiency panels require 50% to 80% more silver per unit than the old models. So, at the exact moment global silver production is struggling, the Chinese solar industry has realized they need significantly more silver, not less. We are receiving verified reports from the Jiangsu province, the heart of global solar manufacturing, that factories are bypassing standard supply chains. They are not waiting for deliveries from refineries. They are going directly to the Shanghai Exchange and taking physical delivery of 15-kilogram bars. They are melting down investment-grade silver to turn it into industrial paste for solar cells. This is a sign of extreme desperation. They are eating the seed corn before the winter even begins. If the solar sector created the fire, the electric vehicle industry just poured 10,000 gallons of gasoline on it. We need to discuss the Samsung shock. Recently, reports have surfaced regarding the mass production timeline for Samsung's new solid-state batteries. These batteries are a complete game-changer for the industry, offering a 600-mile range and a 9-minute charge time. However, there is a catch that the mainstream media is ignoring. The anode in these batteries is not made of traditional graphite. It is made of a silver-carbon composite. The mathematical implications for the silver supply are terrifying. A standard electric vehicle today uses between 20 and 50 grams of silver for various electronic contacts and switches. A solid-state electric vehicle, however, requires up to 1 kilogram, which is 1,000 grams of silver. That represents a 20 to 50 times increase in silver consumption for every single car produced. Now connect the dots to China. China is the world's largest producer of electric vehicles, led by giants like BYD and CATL. Do you honestly believe they will allow Samsung or Western car makers to corner the market on the next generation of battery technology? Absolutely not. We are seeing massive block buys of silver originating from Shenzhen and Ningde, where these companies are headquartered. They are not building these batteries in massive volumes today, but they are strategic hoarders. They saw what happened to lithium prices in 2021, and they are determined not to be left behind. When a company like BYD buys silver, they do not buy 5,000 ounces. They buy 5 million ounces. They are price inelastic. They do not care if the price is $70 or $80. They care about locking up the entire global supply chain to ensure their competitors cannot even enter the race. While everyone was distracted by the holiday shopping rush, the hard data began to leak out of the Western financial hubs. It is critical that you understand the inventory reports released by the Comex just before the Christmas break. In a single 24-hour period, the Asahi refining vault in New York saw a withdrawal of over 1,400,000 ounces of silver from its registered category. You must understand the difference between eligible and registered silver. Eligible silver is simply sitting in the vault, owned by private entities and not necessarily for sale. Registered silver, however, is the lifeblood of the exchange. It is the metal that is fully warranted and available for immediate delivery to settle futures contracts. It represents the actual for sale inventory of the entire market. When you see 1,400,000 ounces leave the registered category at Asahi, plus another 600,000 ounces leave the JP Morgan vault on the same day, you are watching a bank run in real time. The smart money is rushing for the exits. These entities are not playing paper games. They are backing trucks up to the loading docks in New York, loading physical bars, and moving them out of the system. This explains why the arbitrage gap will not close. The inventory that Western banks would normally use to ship to China to lower the price is already being seized by those very same Eastern buyers. Furthermore, rumors are circulating from floor traders in London that the London Bullion Market Association is facing significant administrative delays in processing physical allocations. If London, the vault of last resort, is running thin on physical metal, then the Comex in New York is nothing more than a paper ghost. The West is selling digital promises, while the East is taking the physical reality. Tomorrow morning, the markets in New York reopen for what professional traders call Ghost Week. This is the illiquid period between Christmas and New Year's when the senior desk managers at major banks are away on vacation. Their trading floors are operated by skeleton crews and automated maintenance algorithms. This creates a liquidity vacuum. In a normal market, there might be thousands of contracts available at a certain price. During Ghost Week, the order book is paper thin. It takes very little capital to move the price a very long way. Now consider the high-frequency trading algorithms. These bots do not care about the holidays. They only care about the math. The math currently shows an asset trading at $71 in New York and $80 in Shanghai. The primary instruction of these algorithms is to close that gap. When the Shanghai market opens and confirms the $80 price, the New York algorithms will begin bidding up paper contracts to find equilibrium. Because there are no sellers in an empty room, the price will not move in cents. It will move in dollars. It will gap. This triggers the gamma loop. The bullion banks have sold thousands of call options at strike prices of $72 and $75. As the price gaps up, the bank's internal risk engines are forced to buy silver futures to hedge their exposure. This is called delta hedging. Their automated buying pushes the price even higher, which forces them to buy even more. It is a feedback loop from hell. In a market with no physical inventory to act as a dampener, the paper price must teleport upward to meet the physical reality of Shanghai. The air pocket is open, and the squeeze is about to become violent. Many people will tell you that if silver hits $80, the move is over and you should sell. They are fundamentally wrong. They are using an old map for a new territory. $80 is not the ceiling. It is the new floor. We are witnessing the end of the Western discount era. For 50 years, New York and London used paper derivatives to keep silver prices artificially low. That era ended the moment Shanghai hit $80 and the West could not deliver the metal to stop it. You must rewire your brain for this new reality. In a world where the dollar is being systematically debased and where China views silver as a strategic technology metal, $80 is undervalued. Do not look at the dollar price. Look at the gold to silver ratio. Historically, during a true supply crisis or monetary reset, that ratio compresses toward 15-1. With gold currently trading near $4,200, silver is fundamentally cheap until it reaches triple digits. The easy money has been made. Now comes the volatile money. You will see massive swings. You might see a flash crash on your screen as banks try one last bluff. Ignore the red numbers on your phone. If you hold physical silver, you hold a scarce strategic asset that the largest factories on Earth are desperate to acquire. The strategy is simple. Secure your ounces while they are still available for immediate delivery. Once the retail public realizes that the $80 price in China is the new global benchmark, the remaining inventory at local coin shops and online dealers will vanish in 48 hours. We are moving from a system of paper promises to a system of physical reality. Make sure you are on the right side of that trade.